So today we are going on a mission to really understand this profound disconnect between Wall Street's deeply pessimistic sentiment and the actual, the underlying software reality.
We need to figure out why the market is pricing this hypergrowth giant like it's some legacy dinosaur stumbling into a tar pit.
Exactly. And to do that, we have pulled together a massive stack of sources just for you. We're tearing through Figma's recent Q2 through Q4 2025 earnings reports, valuation models from Simply Walsane, analyst breakdowns from TradingView and Sacra, an incredibly detailed IPO teardown from Sastra.
That Sastra report is fantastic, by the way.
It really is. And to get the unfiltered pulse of the actual people trading this stock, we are diving into raw retail investor sentiment from Reddit. We want to give you a shortcut through the daily noise, so you can see exactly what Wall Street sees and perhaps more importantly, what they might be completely missing. Okay, let's unpack this.
We have to start with the bleeding edge of the news, right? To understand the business metrics, we first have to acknowledge the sheer pain happening in the public markets right now.
Yeah, it's not pretty.
Not at all. Looking at the New York Stock Exchange, under the ticker FIG, the stock is down roughly 49% year-to-date. And in just the last 30 days, it dropped another 32%. The shares are currently sitting around $19.
Well, let me put that $19 into context for you because it is staggering. If we rewind to their July 2025 IPO, they priced the stock at $33. It opened at $85. It eventually peaked at $115.50. At that peak, Figma commanded a $68 billion market cap. Today, that market cap is hovering around $10.5 billion.
They have essentially watched over $50 billion in paper value just
evaporate
in less than a year.
Right. And if you are a retail investor staring at your portfolio, that kind of drop induces sheer panic.
Oh, absolutely. Looking at the Reddit threads from our stock market, you see UI and UX designers like the very professionals who live inside this software every single day, posting things like, I use this product constantly, the demand hasn't disappeared, but the chart looks rough. Yeah, they are watching this steady downtrend where any slight bounce is just immediately and aggressively sold off.
And nature abhors a vacuum, right? When a stock price collapses like that, human psychology demands an explanation, and these narratives just rush in to fill the void.
Always. And it's usually the wrong narrative.
Right. The dominant narrative on Reddit is steeped in total cynicism. Users are quick to point out the history. Late in 2023, Adobe tried to acquire Figma for $20 billion.
And regulators blocked it over monopoly concerns.
Exactly. And Figma actually walked away from that collapsed deal with a massive $1 billion termination fee. But the prevailing theory on the forums is that because the Adobe acquisition failed, the July 2025 IPO was simply a dumper move.
A dumper move.
Yeah, an orchestrated exit strategy so early stakeholders could finally cash out their equity.
I mean, it is so easy to construct a conspiracy theory when you are losing money. But if we put on our analyst hats and look at the actual structural mechanics of the market, the sell-off is really being driven by a three-way financial squeeze. First, you have post-IPO lockup expirations.
Yeah, the Q2 earnings report explicitly mentioned an early release condition where millions of shares became eligible for sale in September 2025.
Right. So when a company goes public, the early employees and venture capitalists are legally restricted from selling their shares for a certain period. When that lockup expires, a massive flood of new supply suddenly hits a market.
And if demand doesn't immediately match that new supply,
the price naturally gets crushed. Basic economics. Now, the second gear in this squeeze is a massive multiple compression across the entire software as a service, or SaaS, sector.
Let's break down that term for a second. When you say multiple compression, what is actually changing in the minds of the investors?
So investors evaluate software companies based on a multiple of their revenue or earnings. During the zero interest rate era, investors were willing to pay, say, 30 times the company's future revenue because money was cheap and growth was everything.
Right, the growth at all costs era.
Exactly. Yeah. Today, the macroeconomic environment has shifted. Investors are significantly lowering the premium they are willing to pay for every single dollar of software revenue.
Even if the company is executing perfectly.
Exactly. If you look at the TradingView data for Figma's peers, well-established giants like Atlassian and Adobe, they are also down heavily. I mean, Reddit users are noting their own Atlassian holdings have dropped 60%. The market is systematically punishing the entire software sector, regardless of individual company performance.
Okay, so that explains the broader market mechanics. But there is a very specific, almost existential fear popping up in these forums that acts as the third gear in this squeeze. One user made this haunting analogy. They asked, is the UI/UX design field facing a switchboard operator moment?
Wow. Yeah, the fear that an entire profession is about to be rendered obsolete overnight by new technology.
Exactly. If generative AI tools from companies like Anthropic or OpenAI can eventually build a complete software interface from a simple text prompt, why would an enterprise pay for a collaborative design canvas?
Right, Wall Street is treating generative AI as an asteroid headed straight for Figma's core business model.
But the data tells a different story.
A completely different story. The financial data shows their internal strategy is, well, Figma is not waiting for the asteroid to hit. They are spending massive amounts of capital to become the asteroid. They are executing a hard pivot to become an AI-native platform.
Let's look at the mechanism of how that actually changes the user experience, because they aren't just slapping some generic chatbot into the corner of the screen. At their Config 2025 conference, they launched Figma Make, which is an AI-assisted prototyping tool. They also acquired a company called Weavy.
Now rebranded as Figma Weave.
Right, Figma Weave, to bring AI-native video, motion design, and visual effects directly into the interface.
And crucially, they are strategically avoiding the cost of training these massive foundation models themselves. They are partnering with the dominant players. They integrated Google's Gemini 3 Pro and Imagen 4, which cut their image generation latency in half.
Oh, wow.
Yeah, and they partnered with OpenAI to integrate the Figma application directly into ChatGPT.
There is this wild detail from an interview with Figma CEO Dylan Field. He didn't just use AI to, draw a nice button. He typed a prompt, and the platform natively generated a massive, hyper-complex tech tree diagram mapping out technological progress all the way to the year 2100.
Right, the AI acts as a generative coworker rather than just a dumb drawing utility.
But let me stop you there, because building that kind of infrastructure is brutally expensive. If I'm an investor, I am looking at the cost to generate those complex AI diagrams, and I'm sweating.
And you would be looking at the exact reason Wall Street is punishing the stock. In 2025, Figma's cost of revenues surged an astonishing 112% year over year. The sources show they had to spend $49.1 million purely on technical infrastructure and hosting costs tied to artificial intelligence.
So they are bleeding gross margin right now, because Figma used to boast an incredibly high gross margin of 92% back in 2024. That is elite software territory.
Sure, yeah.
But because of these heavy AI compute costs, their gross margin dropped to 82.4% in 2025. And looking ahead to 2026, management is actually guiding for operating margins to dip down to around 8% as they continue to invest in this infrastructure. Are they just eating these massive compute costs indefinitely to keep their market share?
What's fascinating here is the massive disconnect in time horizons between Wall Street and Figma's management. Wall Street is notoriously myopic. They despise short-term margin compression.
They just see the numbers go down and panic.
Exactly. They see infrastructure costs skyrocketing and margins shrinking, and their immediate reaction is to sell. But Figma is taking a deliberate, calculated short-term hit to build permanent, long-term platform lock-in.
Meaning they get the enterprise teams hooked on Figma Make and Figma Weave, while it's essentially subsidized, knowing they can't simply rip it out of their daily workflow later.
Exactly. It's a classic land and expand on steroids. And the catalyst for recouping those costs is arriving shortly. Starting in March 2026, Figma is shifting to a hybrid seat plus credit model to actively monetize this AI usage.
So if an enterprise wants more AI generation, they have to purchase credit packs on top of their standard seat licenses.
Precisely. And the pre-monetization data is incredibly bullish for that transition. According to the sources, 75% of their customers who spend over $10,000 a year were already consuming AI credits on a weekly basis before Figma even started charging for them.
Wow, so the habit is already formed.
Yeah. Once that infrastructure is deeply embedded into a company's daily operations, the friction to remove it becomes much higher than the cost to simply buy more credits.
Which brings us to the biggest plot twist in this entire deep dive. Because if AI is fundamentally changing how we design software, we have to look at who is actually using Figma right now. If you ask the average person on the street, they will tell you it's a specialized tool for graphic designers.
But the data reveals a fundamental paradigm shift in their user base.
Here's where it gets really interesting. According to the data from Sastry and Sakra, out of Figma's 13 million plus monthly active users, a staggering two-thirds of them are non-end designers.
Just think about the implications of that for a second. The addressable market just tripled in size.
Right. In the first quarter of 2025, 30% of all Figma users were developers. They are flocking to a feature called Dev Mode,
which solves a massive pain point. Historically, the handoff between a designer drawing an interface and a developer writing the code to make it function has been a notoriously broken, frustrating process. Dev Mode bridges that gap natively.
Furthermore, when you look at the new AI tools, 60% of the files generated in Figma Make are being created by people who do not have designer in their job title.
Which is insane. Let's look at the financial mechanics backing up this adoption. For the full year of 2025, total revenue hit $1.056 billion. That's a 41% increase year over year. But the retention metrics are what truly validate this non-designer adoption strategy.
I was looking at those numbers and my jaw dropped. Their net dollar retention is at an elite 136%.
Right, and for anyone unfamiliar with that metric, net dollar retention measures how much your existing customers expand their spending over time, even after accounting for the ones who cancel.
So a rate of 136% means?
It means that if Figma acquired 0 new customers this year, their revenue from their existing base would still grow by 36% simply because current clients keep adding more seats and buying more features.
That is just incredible. And their gross retention for customers spending over $10,000 a year is at 96%. Once an enterprise signs a major contract with Figma, they simply do not churn.
It becomes part of the corporate nervous system. The Sastra report highlighted a dynamic they called the 80-20 rule on steroids. Just 2.5% of Figma's customers, which is roughly 11,000 accounts, generate 64% of their total annual recurring revenue.
Okay, I hear that, but let me push back for a second. If they've already captured all these massive accounts, isn't the hardest part behind them? It seems like they started by displacing siloed single-player tools like Sketch and Adobe XD. Now they are this real-time multiplayer orchestration layer where, the product manager, the copywriter, the designer, and the coder are all collaborating simultaneously. Are they essentially becoming the Google Docs of software development?
That is exactly the underlying thesis here. And the data shows they have not hit a brick wall regarding expansion. In fact, it opens up massive avenues for 2 distinct types of arbitrage: geographic and enterprise.
Okay, let's unpack the geographic side first.
Currently, 85% of Figma's monthly active users are located outside the United States. However, international markets only make up 53% of their total revenue.
So they have an enormous global user base that is highly active, but they haven't optimized the monetization levers for those regions yet.
Precisely. It represents a massive well of future revenue growth. Now look at the enterprise arbitrage. The data shows that 95% of the Fortune 500 uses Figma in some capacity.
A skeptic might look at that and say, well, the market is entirely saturated.
Right, but here is the critical mechanism. Only 24% of the Forbes Global 2000 currently spend more than $100,000 a year with the company.
Oh, I see the gap. Practically every massive global corporation has small, isolated teams using the software. But Figma has only scratched the surface of converting those small pockets of usage into massive, wall-to-wall enterprise contracts.
The runway to upsell those massive corporations is still incredibly long. Figma utilizes a bottoms-up sales motion. Individual employees or small startup teams start using the free or low-cost tiers. As they collaborate, they invite other departments into the canvas.
And it spreads like a virus.
Exactly.
How's that?
Eventually, the usage becomes so widespread across the company that the IT department is forced to step in and purchase a massive enterprise license simply to manage security, access, and permissions. 70% of their new enterprise customers follow that exact organic upgrade path.
Okay, let me synthesize this for you. We have an incredibly sticky product, near-perfect enterprise retention, a massive runway to upsell the largest companies in the world, and successful early adoption of their new AI features. How do we reconcile these brilliant underlying business mechanics with a stock price sitting in the basement at $19? Is it actually a screaming buy right now?
To determine fair value, we need to examine the valuation models provided by Simply Wallsaint, which essentially present 2 completely conflicting views of the company's future cash generation.
Okay, let's start with the pessimistic view, the bear case.
Simply Wallsaint calls their bear model the user narrative, and it suggests a fair value of $18.79. In this view, even at $19, the stock is still slightly overvalued.
Wait, if retention is at 136%, how are the bears justifying a valuation that low? Are they assuming the AI infrastructure costs just permanently destroy their profit margins?
Basically, yes. The bear narrative relies on the assumption that the hypergrowth phase is permanently over. They look at the lower gross margins caused by the AI compute costs. They look at the looming threat of well-funded competition from tech titans like Microsoft and Adobe pushing their own AI tools, and they assume Figma's revenue growth will rapidly decelerate.
So they think the market's current price-to-earnings expectations are still far too optimistic for a company transitioning into lower margin maturity.
Right. But there is a totally different, highly analytical way to run these numbers.
Yes, the bull case.
Yeah, the bull case relies on the discounted cash flow model, or DCF. A DCF model attempts to strip away the emotional panic of Reddit forums and the short-term anxieties of Wall Street. It calculates the present value of every single dollar the business is projected to generate over the next decade. According to the Simply Wall St. DCF model, Figma's true fair value is $27.13.
Which would mean the stock is currently nearly 30% undervalued by the public markets.
The DCF model suggests that the market has fundamentally mispriced Figma's future cash flows because institutional investors are entirely too distracted by the short-term margin hit from the AI infrastructure build-out.
Wait, I'm looking at these cash flow numbers and I am confused. If their retention is so high and they are converting these massive enterprise contracts, why did I see a headline about a massive net loss in the third quarter of 2025? If you just glance at the GAAP profitability, it looks terrifying.
You have to look at the mechanism behind that specific headline. During the IPO quarter, Figma took a $975.7 million hit in stock-based compensation.
Ah, so it's a one-time accounting event tied directly to going public.
Exactly.
Yeah.
It severely skews the generally accepted accounting principles, or GAAP, net loss. But that is not actual cash leaving the bank account to pay bills. When you strip away that accounting fiction and look at their adjusted free cash flow, the actual cold, hard cash the business operations are generating, it sits at a very healthy 23% margin for the full year of 2025.
So despite the terrifying headline net losses, the core business is highly cash generative.
Yes. If we connect this to the bigger picture, it perfectly summarizes the tension for anyone evaluating this company. On one hand, you have a business with incredibly durable customer cohorts. The Sandstrom report noted that the cohort of customers who joined back in 2020 have organically grown their spending at a 46% compound annual growth rate over 4 years.
46% over 4 years, that's wild.
And 76% of their users rely on multiple Figma products. They aren't just buying a single tool. They're migrating their entire workflow into an ecosystem.
Yet the broader market is pricing Figma like it's a legacy software company waiting to be disrupted by AI generation.
While the underlying behavioral metrics suggest Figma is actually the platform doing the disrupting, they are the ones absorbing the workflows of other tools.
So what does this all mean? Ultimately, this is the puzzle you have to solve as you evaluate these sources for yourself. Do you agree with the retail panic? Do you believe that AI is going to commoditize software design to the point where the collaborative canvas becomes a relic, making that bear case of $18 the harsh reality?
Or do you look at the fundamentals?
Right, where you look at the deep, adjusted free cash flow metrics, the staggering adoption by developers and non-designers, and the massive enterprise expansion runway, and conclude that Wall Street is currently offering a 30% discount on the future operating system of software development.
It is a classic battle between short-term market narrative and long-term business fundamentals. I want to leave you with a philosophical twist to mull over, which actually comes from an interview with Figma's CEO, Dylan Field, sourced from Wired.
I read that interview. It completely reframes the entire purpose of the software.
It really does. Field points out how our cultural relationship with digital design has evolved over the decades. In the early 2000s, design was largely superficial. It was just about making a website look pretty. Then in the 2010s, heavily influenced by the philosophy of Steve Jobs, design shifted to be about function, how a digital product actually works and feels in the hands of the user.
And how does he define design today in the era of artificial intelligence?
Today, Field argues, design is fundamentally about communication. It is how a brand speaks, how it establishes trust, and how it engages with the world. So think about that Reddit fear we discussed earlier, the fear that AI will eventually act as a switchboard operator and just generate all the underlying code for every application.
The fear that makes the human designer obsolete.
Exactly. Let's assume that fear comes true. Let's say in 5 years, an AI model can instantly and flawlessly generate 100% of the underlying code for any software application on Earth. If the code itself is entirely commoditized, free, and handled by machines, does the visual collaborative canvas of Figma suddenly become the only place where human intent actually matters?
Wow. If the code is free and infinite, the only differentiator left for a business is the design, the empathy, the specific human communication, all of which is orchestrated on the Figma canvas. That is a brilliant way to reframe the existential threat into the ultimate bull case. Thank you for joining us on this deep dive into the underlying metrics, the market panic, and the platform reality of Figma. Keep exploring these sources, weigh the evidence we've unpacked today, and trust your own analysis as you figure out where the market is heading next.